lawyer
recording.
is always a good thing.
Yes, knowing a lawyer is always a good thing. It's part of your team, right? When you get into real estate or any business, you need to have a team of players.
Yep.
So an attorney is one of them. I believe what Jay does is another team member that you should have. So these are important people that you should have on your team. So at this point, I'm going to hand it over to Jay and
Yeah.
let him kick off the discussion.
Great, thank you
Thanks,
very
Jay.
much. Thank you very much, Scott. And let me just say that, working with Mark, Mark graduated Villanova and MBA, law, cum laude. He's one of the smartest attorneys. And I gotta tell you that I'm not a big fan of attorneys. I don't really like many attorneys, but I really like Mark. And I think that really makes it easy for me to work with Mark because I really like him. He's personable, down to earth, and he's not going to talk legalese to you. So one of the things about Mark that I enjoy most when we get a chance to work together with our clients is our relationship and the ability to do work. Mark is going to work with me here tonight, and if you have questions, what I would say is maybe throw them in the chat so that we could monitor that. We're going to try to stay at a really high level. We don't want to get into the nitty gritty of things because once you open up a can of worms, we can sit an hour and talk about one topic. So I'm going to speak, and again, my name is Jay Moda. I'm a certified financial planner. I have a financial planning practice based out of New York, New Jersey, and Chicago. On my team, I have various people in different positions from financial planning, financial advisors. We have investment analysts, asset managers, insurance professionals, both on the life, health, and on the property and casualty side. I have a CPA who works out of my Chicago office and another certified financial planner. So I put together a team so that we can provide comprehensive financial services for our clients. I particularly focus mostly with the business owner and the small business owners. I get the most joy out of working with business owners because being a business owner myself, I understand how difficult it is when you're a business owner to run a business and have a family and be profitable and keep your sanity all at the same time. So with that being said, tonight's presentation is mostly about protecting yourself and protecting all of that hard work that you put into that business, all the years that you put into it, and the catastrophic events that can just take it all away. And I've seen, unfortunately, firsthand, families that have suffered greatly because planning wasn't necessarily done. There are amazing business owners out there who run phenomenal businesses, employ a lot of people, but they miss that one component, which is making sure that their business has a succession plan. And there is some place that the business could go so it could out-survive them and provide for their families if they should pass away prematurely.
Hey, Jay,
Yes, sir.
let me just do this real quick.
Yep.
Can everybody put in the chat or say something about if they already have a business, if they have multiple businesses, or if they're going to start a business? So we have a feel about how many people are attending that have different levels or where they're at.
Who's
And
in
if
the
you're on-
audience? Yeah.
And if you're on Facebook, if you could respond with that as well. This way we have a clear picture of what we're,
Well, we
who we're
have a
talking
few on
to.
Facebook, if they could give us a quick answer, and there's few on the watch party. So let us know. Do you have a business? Do you want to start a business? What was the
Scott,
other
I'm going to
one?
let you tell me because I can't see the chat box because I'm sharing my screen. So I'll let you kind of let me know if you see any questions come up.
We got a
Yep, I'll let you
business
know if-
owner
yep.
starting a business.
Yeah, we already have an owner and somebody starting a business.
Okay.
If you have any questions, put them in the chat. Let us know on Facebook if you have any questions during the presentation as well. So right
Don't
now,
be shy.
right now it looks like we have, okay, somebody has 4 LLCs, 1 S Corp, 3 partnerships.
Wow.
So it's,
Way to go.
yeah, that's good. That's great.
A lot of decisions made in that business for that business owner. All right, so this is what I use Mark for. Mark wrote this disclosure for me. This is the legalese that everybody has to give before the presentation. Of course, I'm joking, but really what this is just telling all of you is that, I'm a certified financial planner. Although I can talk about certain things, it's not my role to give you legal or tax advice. I'm not a certified public accountant. I'm not an attorney. The work that I do oftentimes goes hand in hand with those professionals like Mark. So just got to give you that quick disclaimer, and I hope you're quick readers because I'm moving on. So the business continuation, it's a process. It's not just exit strategies. Most people think, well, I don't have to worry about business continuation because I just started my business and therefore, I'm not getting out of my business anytime soon. And the reality is that business continuation planning is much more than just an exit strategy. It really incorporates all the phases of the business life cycle. So when you're getting started, as you're working in your business, and when you're planning on giving up control, whether you're giving up control because you're ready to retire, or you're forced to give up control because of a medical condition, or God forbid, a death in the family, a death occurs and you're no longer with us. You all that are business owners employ almost 100% of everybody that works in America. I mean, I know that sounds crazy, but 99.7% of employees in the United States work for small businesses, which are under 500 employees. And that's to all of you. So I don't know how many people here have employees, but that's a significant amount of people that are working in small businesses. And if you do have employees, as an employer myself, we don't only have a responsibility to our business, our clients, but we have a responsibility to our employees to provide an opportunity for them to work. Only 36% of small business owners have a continuation plan if they should die. And we'll talk about different ways of funding it, but only 39% of them have it with life insurance to fund a continuation plan. So when you're forming a business, the first thing you want to do is create your team. Whatever the business may be, I believe everybody on today's meeting is involved in real estate, and maybe one of your businesses, if you have multiple businesses, is real estate. Maybe you have different types of businesses that you operate. But once you decide you're going to own a business, or if you have a business, you should have an accountant, you should have an attorney, you should have a financial advisor. Depending on what type of business you're in, you may need particular experts in that field. But one of the things you need to do when you're starting a business, or if you have a business, because again, you can change along the way, is to decide how is your business going to be organized. I have this conversation with a lot of people who don't know. They go online, they register their business, and they just do what someone recommended they did, but they didn't do the research to realize what the different entities are and how the different entities will affect them in the future. So you have C corporations. I think most real estate investors probably are setting up pass-through entities where they're either partnerships, limited liability companies, and S corporations. The other question is, how long do you stay an S corporation if you are an S corporation? And that's something that, as business is happening throughout the years, you're going to have to revisit and decide, are you properly titled? Are you properly protected? How much liability are you taking on as an owner? How much income? I mean, there's so many things to consider in this capacity. Mark, I don't know if you have anything you want to speak to about, forming the business and in this slide here.
Sure. I guess what I'll do first is give you guys just a little bit of backdrop about myself and our firm. But it's a pleasure to be here. I'm home, but it's a pleasure to be with you guys, and thanks for having me. One of the most important things about these kinds of conversations and being a part of this is that you guys want to be here, okay? And you want to listen, and there's something that you want to get out of this. Throughout this call, if something comes up where you're not sure about something and you want to ask some questions, you can always, at some point my information should be shared, and you guys can reach out to me separately also, or to Jay, and reach out to us, because like we said, there are some things that we'll go over, but we clearly can't cover everything in depth, and you probably don't want to hear everything in depth. You want to get a good idea of what this is all about, and whether or not this might be something more that you want to hear from us, at a future date. And so our firm is Wells, Jaworski and Liebman. We started out as a land use firm. We still are, and represent a lot of developers. We deal with anything dealing with real estate. And from there, those developers have companies. So business, commercial, transactional work, and the wealth that they develop, there's tax trusts and estates. And then we litigate anything that we do. So we stick to what we're good at and we stay with that. So and where I fit into that is I handle tax trusts and estates and business and commercial matters. And because of what I do, I handle companies that need help on the corporate end, but I can also take care of them on the personal end. And where does that fit in? That's really on the succession planning. That helps a lot of my clients need help in that area. And whether they're forming a business or they're trying to dissolve a business, or they want to bring an employee in as an owner, or they want to figure an exit strategy and how to get out and create some value for what they have. Now, if you're in real estate, well, there's already some inherent value. If you're in a service industry, well, what do you do with that company in order to continue it or get some value out of it? Those are the kinds of discussions that we have, and we pull in the right advisor. And you should always speak with your accountant too. So we work very closely, with guys like Jay and accountants, and maybe even other lawyers, depending on what's going on. But if you're dealing with a succession plan, you're really dealing with me, and that's one of the benefits. You don't have to go to an estate planning attorney and figure out what to do with your will and or a trust and how that fits into your corporate plan and go to a different attorney. So one of the things that we typically, if this is real estate that you're dealing with, you're largely wanting to set up a limited liability company. One, it protects you from your personal assets from your business assets. And there's some differences and nuances between maybe an S Corp and an LLC. Typically, if it's a service company, a lot of accountants like to set it up as an S Corp. There are some tax benefits for having an S Corp for services if you're paying yourself. If you're collecting rents and you're a real estate company, most of the time you're setting up a limited liability company. And there's reasons for that. So how many LLCs do you set up? Do you set up one? Do you set up more than one? Do you set up subsidiaries? A lot of stuff we'll go through with our clients. And the most important about this planning process and exit strategies, this is tailored to you. So we have to learn a lot about you. We have to understand what you like, what you dislike, the good, the bad, the ugly, what works for your family, and what you want in the future. And from there, we tailor a plan, and then we think about the tax consequences and all that kind of stuff. So really what you want is most important. So it can be any one of these entities, but you really don't see real estate companies having C Corps. That's one thing for sure. It's very, very rare. And if you do see it, it was probably formed a very long time ago. And there are usually a ton of built-in capital gains over there. So you want to stay away from that. That's my take on it.
Yeah. And Mark, I should apologize. I should have given you an opportunity to introduce yourself earlier, and it escaped me. So
I took it.
apologize.
That's okay. Okay. Thank you.
So, and again, this is for those people that, not only the real estate investor, I know everyone on here is, based upon the real estate investment and your group, but it is important. And as Mark mentioned, you should be a limited liability corp, but obviously, for that person that has multiple businesses, you should, any business owner I speak to, we always revisit the organization and why it was organized that way to make sure that it's still appropriate. And the one thing I'll mention is that, as Mark mentioned, working with your professionals and keeping them involved in your decision-making is probably one of the more important things, because you'll get the advice you need. And to that point, it's important to understand who the owners are when you're thinking about business succession. How many partners are there? What type of partnership is it? Is it a limited partnership, general partnership? Is anybody actively working as an employee? And I think in business succession, one of the key things is, especially in your group, you may have partners who are related with one another, husband and wife, or brothers. Oftentimes I see, brothers get together and they want to go out and buy real estate and they want to start, getting rental properties. And understanding that relationship and that dynamic there is important. So these are all things that you want to share with the professionals you work with. One thing about the relationship side of it, what I find is, the equalization. And when it comes to liquidating or a business succession plan, oftentimes it comes down to an argument about who has done more for the business or who's more involved in the business, and who should get what from the business. And unfortunately, if one of the members dies, that argument is really hard to solve because one member is not here and now you're dealing with the family. So we talk about estate equalization, and like, let's say for an example, you have children that get involved in the business with you, and they're not listed as owners of the business, but they are the ones that are going to carry the torch. Maybe you have multiple children and not every child is involved in the business as one may be. And you're thinking to yourself, well, I'm going to leave my business to my child that's been actively involved in the business with me. And then you have other children who haven't been involved that don't get anything from the business if you pass away or decide to retire. So, estate equalization, I think, is one of the important factors when we talk about succession planning that should also be considered. And Mark, if you have anything you want to, chime in, just please jump in and, feel free at any time.
Sure. So I mentioned a lot that a lot of this happens to be personal stuff, and a lot of this happens to be business stuff. And on the personal end, when thinking about an exit strategy and who to give to what and how and when, I'll speak a little bit to estate taxes and inheritance taxes and how that factors into the kind of planning that you might want to think about. First, the Tax Cuts and Jobs Act bumped up that exemption to, now it's at 11.7 million per person, or double that, call it 24 million per husband and wife. So you can give away or die with 24 million, and there'll be no estate taxes that your estate would have to pay.
Yes.
Well, let's so that's a lot of money, right? That can add up quickly, but in 2026, that number gets cut in half. So then 6 million goes down to 6. And there's a lot of talk soon, with Biden in office, that it might go down to 3.5. It could go down to 1 million. They're talking about eliminating or capping a step up in basis, which is so important for income tax consequences. When you die, the cost basis goes up to fair market value. Your kids sell the asset, no capital gains. That could go away, or there could be a cap put on it. And so the advice right now is, while you have that amount of money to be able to give away that 24 million, if you're somebody who's in millions, or if you're over 3.5, you're 5, you're 10, and you're not really sure what you should do, this is a time where, if you don't use it, you'll lose it. So we have clients who own real estate across the United States. We're in Jersey. We do deals all across the United States, and we're doing a lot of planning for them also. And one of the things we're doing is making sure that we benefit their kids by gifting a lot of those companies over now, and using the exemption while it's at that 24 million. If you're somebody who said, well, I don't have that much, well, remember, it's going to go down a lot. And what's the tax rate above that? If you're over the limit, well, right now it's 40%. There's talks about making that 45%. So every $1 million that you're over the exemption, that's $400,000 just goes to the government. And that's only federal estate taxes. Right. New Jersey is one of the states that still has an inheritance tax. So if you're leaving something to somebody that's not a parent or a child or a grandchild, there's some kind of tax, unless of course it may be the charity, which can be anywhere from 10, 12%, 15 or 16%. So there's a lot of things to think about when you have, say, a real estate holding entity, and you have some considerable wealth. You really want to think about the planning process for tax purposes, but doesn't matter. Even if you're well under the threshold, thinking about where you want your stuff to go, is best to do that while you're here and you can govern what happens and take control of it, and while you're active with the company. While you're actively making decisions, take care of that stuff too. You don't have to give up control right away, but you can put those things into motion now, and do what you want with it, rather than have somebody else figure it out, or have somebody else think about what's best for you, or have a court think about what's best for you. We try to avoid those kinds of things, and that's where we come in.
Great, yeah. And that just brings home the point that when you're looking at business continuation, it's not something that is a final plan and you wait until you're ready to leave the business. That's something that you have to start planning for now. As Mark alluded to, with the changes that are impending after the Jobs Cuts Act is over in 2026, and the other changes that may happen, beyond that, you have to start planning now for those contingencies.
Hey, Mark, have you heard of any progress with what they were mentioning a few weeks back on potentially taxing unrealized capital gains?
A lot of people ask me, I heard about something or I read something, and a lot of it is real, that at least it's brought up. But there's a lot of it that is speculation right now. And there's some of it that's real, like 2026, that goes away. That's law. But a lot of it is speculation right now. You see the wealth tax that's being proposed, and all other kinds of proposals. Moving to the Canadian system of taxation, where you're taxing, where you're dealing with the step up in basis and taxation more on the income tax, and maybe eliminating an estate tax. Well, either way, it's kind of getting you, because if you have to figure out what's right for you. And so no, there's nothing that's being moved right now to tax somebody on unrealized gains. I mean, which is tough. I mean, you don't have the cash, you didn't get the cash, and you're still getting taxed on it. Like, man, you're gonna have to get the cash. You're gonna sell what you have. Then it's really I can't see happening. And a lot of people have relied on that step up in basis for many years, and that's been around for a long time. And as long as I've been practicing, way before that, and to get rid of something like that would be really bad for a lot of people. So I hope that doesn't happen.
Yeah, me either. I just figured I'd maybe, because you follow different trends and different channels than I do, so that's why I want to throw it out there.
Please, yeah. Open question.
So when you're looking at, and Mark, I mean, the knowledge you have with that, which is why I was really excited when you were willing to join us, because I knew you'd bring that value. When we're looking at starting up the business, and you're in your business, there's certain ways that you need to protect. You need to protect your income, protect your property, protection of loss from a key person that could destroy your business, right? So most businesses that have employees may have one key person, and what you don't think about is when you're a sole proprietor, if you're by yourself, you are that key person. So if you have real estate and you know what you're doing, and you're at it alone, if you don't have adequate protection against the loss of you, then what happens to your business, and how does your family recoup what that business is truly worth? A lot of times we see, I have many stories of business owners who passed away ill-prepared, and there's a fire sale. And if you're dealing with real estate is not always liquid. You can't always sell it right away. I mean, right now the real estate market's hot, and you can't even get it on the MLS before it's sold.
Yeah.
But what happens if we go back to a 2007, 2008, when real estate hits a low, and you pass away and you own all this real estate, and your family needs to liquidate it at the wrong time because they don't have any cash. So you are the key person, in planning for that, making sure that you have the right protection in place is important. Property and casualty insurance, that's obvious. I'm not even going to discuss that. Disability income, disability income, if you can no longer run your business and you have overheads, disability could be a factor. There's different types of disability policies that can protect against that. And then family protection as well, as we talked about with the key person, making sure that there's protection in place so that your family is taken care of. So there are many different ways that business owners may want to pass the baton or create an exit strategy. It doesn't have to be with death. It could be for retirement. But you have both the expected and the unexpected. Identifying who that person is going to be. So if you have children and you think that one of the children, or I spoke with a business owner the other day and he thinks his brother-in-law is going to take over the business, but identifying early on who you believe is going to take over the business and making sure that there's a strategy for that to happen. Again, without getting into detail, there's differences between selling to somebody within the family and someone outside. As Mark mentioned earlier, dealing with the estate and gift taxes and the rules, how that changes and how that can affect your transfer of the business. And then with the entrepreneur's retirement needs, cash flow. There are a lot of strategies when you're planning on retiring that you can still create a cash flow for yourself through your business to provide you throughout retirement. So there are three major, or I would say these are the three strategies that you would utilize for an exit strategy. You have buy-sell agreement. You need to have, the buy-sell agreement. In order to have a buy-sell agreement, you need to have a proper business valuation. I'm getting ahead of myself, and a funding mechanism for that buy-sell agreement. So the buy-sell agreement, this is where Mark comes into play, because Mark is the one that's going to sit down with you and the partners to create a buy-sell agreement, which will identify who, when, and how much. It's going to create a ready market for the business interest. So the value of the business will be established through this. It protects, doing the correct way and transferring the business the correct way will help protect the surviving business owners. And as I mentioned, for tax purposes, it creates the value of the business when you do the buy-sell agreement. So what is a proper business valuation? By the IRS, it's what a willing purchaser is willing to pay. And that's what we consider to be a proper business valuation. And again, there are multiple ways to value a business. And again, that's getting into the weeds. Mark, if you want to chime in on valuing a business, feel free, but I was just going to keep it high view.
Sure, and I'll add to that in the sense that, yeah, it's great to get an appraisal of the business valuation. I worked with a forensic accounting firm for a few years while I was licensed, and worked in that industry, and I have an accounting background also, and I've worked with business valuations and mediations and damage claims and disputes, and what is the real value of the business, and some of that can be really tough. Hey, what's great is if everybody can agree on it without having to go through the whole process and come up with something fair. That doesn't always work. An alternative could be, well, we're going to have the accountant figure out a method that's fair, or we're going to choose an independent person, or we're going to have the company's going to choose somebody, I'm going to choose somebody, they're both going to come up with values, and then if they can't agree, they're going to come up with a third person, average it. There's ways to figure it out and keep going. And what we would do in a typical buy-sell agreement is we could develop a few phases more. If everybody can't agree on this aspect of it, then we'll go to the more formal process and so on and so forth. So there's simple ways to do it, and then there's planning part where if it doesn't work out in a simple way, there's a real way to get it done that of course costs more money, but it'll get the job done and get a fair value.
And to that point, what we were just talking a moment ago, the two approaches, the liquidation value and ongoing as an ongoing concern. So someone passes away or something happens catastrophic, the liquidation value, sell off all the assets and pay the liabilities, and whatever's left over, that's what you have. And ongoing, based on earnings, and what someone would pay for a profitable business. So this is where I started going on earlier when I talked about 3 different ways for buy sells to work. Given that everybody here will probably be a limited liability corp, you have the entity buyout, you have a cross purchase plan, and then the wait and see plan. So an entity buyout would work where the LLC would actually own a life insurance policy on both or all the owners. And upon the death of one of the owners, the corporation would basically would receive the death benefit from a life insurance policy and then be able to buy out the owner's family. And this is one of the easier ways, I would say, to achieve this. Some challenges are, does the business have the money to pay for the life insurance premiums, and are the owners insurable? You have the cross purchase agreement. This can get very expensive and could require a lot of different policies, especially if you're dealing with multiple owners. The cross purchase agreement, where you have 2 owners in this example, A and B, and each of them are going to buy a policy on the other one. And then when when the death benefit is received, then they have the money in order to pay off the family members from the deceased owner. Things that we consider when we look at this, and Mark talked about taxes and transfers, step up in basis, not a step up in basis, what increases the basis in the company. All of these plans have a lot of different things that go into it, and selecting the right plan is really important based upon what your specific needs are, what kind of capital the business has, and the valuation and how much insurance you're going to need. Mark, before I go on to the next one, do you have anything you want to mention on these 2 slides?
Hey, well, there's a lot that goes into these things.
Of course.
And just to keep it high level, it really involves a sit down with the partners of the company to figure out what's most practical for you. And often you've been the sole owner this whole time, and you're inviting somebody else to the dance, or you're bringing an employee.
Uh-oh.
Mhm.
No, he froze.
Oh, no.
Yeah.
It's like, oh, no. Oh, no. So I'm guessing everybody's heard that on TikTok before.
Yeah. That happens to me when my wife uses the microwave when I'm at home. The Zoom freezes. I don't know what it is. But
Could be just the weather. He's up North Jersey, right?
yeah, he's up by me in Bergen County. Yep.
Okay. Maybe
So-
it's the weather.
What he's really getting at is, and again, I try to keep it very very simple. When we're dealing with these types of arrangements, knowing who the parties are involved, how much it's going to cost, how it's going to affect, the family, how it's going to affect the business with step up in basis, no step up in basis, transfer for value. I mean, there's a lot of different components that go into this, but this is just to give you an idea of things that you should be looking into as business owners as ways to create a succession plan. Yep.
Just for out of curiosity, succession plan.
Yep.
What's
So a
that?
succession plan is essentially a plan for a person to succeed you in the business. Like
Okay.
what's going to happen if you're no longer in the business? And it doesn't have to be for death. It can be because you're going to retire. And if you retire, who's going to succeed you in the business? Another option is a trusted cross purchase, where instead of each owner having a policy or a contract on other owners, you can have a trust established, which would own a policy on each of the owners. And again, this all depends on the structure of your business, how many people are involved, and ultimately what makes best financial sense.
Are you allowed to tell us, like, what are some of the things that people would not be able to get the insurance if they had?
Certain conditions, I
Certain
guess, that would prevent them.
Yeah, I mean, that's a broad range of items. Like, I mean, I can't see, I mean, there's a lot of reasons why. I mean, I'll tell you this, when it comes to life insurance for funding these buy-sell agreements, I think that age difference is a big issue when you get a younger partner and an older partner. Obviously, the older partner is going to pay a lot more for insurance than the younger partner. So how do you make that fair? And then medical conditions as well could affect the ability to do this. I mean, if you can't use life insurance, you have to find some other funding mechanism, whether it be a sinking fund or something to create the funds in order to transfer, the business to the other party or have the money. I mean, let's face it, if you have two partners without any kind of agreement and one partner dies, and we've talked about this in our other conversations, essentially you become a partner with that person's family or wife or children. So,
Yeah.
there's not I can't say that there's one reason why somebody would get declined. I mean, there's a lot of different reasons. And that's why it's important to consider all of your options and understanding, who the people are in the business. Mark, nice to have you back.
You're on mute.
Muted.
There you
Thanks.
go.
I thought I'd make it interesting. Lost power. I don't know. Happens.
Yeah.
So, Mark, I don't know if you want to finish any thoughts on what you were talking. I just basically said that, when we look at these types of plans, there are so many variables, and understanding who's involved in the business and, finances, making these decisions is not as easy as just picking one and going with it. It takes a lot of time to consider and looking at all the variables.
Yeah, sure. I'll give you a quick example of what I'm working on right now. We represent both sides in this. Sometimes we represent the employer, the principal, and other times we represent the employee who's going to become an owner. In this case, it's the employee who is going to become an owner. The principal is going to give him about 10% in the company, and it starts to raise questions. Well, how does he get the 10%? Is it a gift? Well, if he's purely an employee, you can't just gift it to him. That's compensation. Who's paying the taxes, and on how much? What's 10% worth? Where's that coming from? What can we do to minimize the consequences? And maybe he's buying in, or she's buying in. What's the best way to do that? How much of it can we allocate towards personal goodwill if there's a sale of something? We've done that, and that's capital gains, 15-year amortization. Great way to spread it out rather than having a ordinary income tax get triggered. So we've saved some principals millions of bucks by structuring a transaction properly. When selling to either to a son or a daughter or to an employee. You want to think of these things because there are gift tax consequences. There are income tax consequences. And you want somebody who's well versed in these, who does these enough to be able to identify the issues and pull in the right people.
Oh, hi. You said you can use this insurance to help the kids to pay the inheritance or the whichever taxes and stuff that they end up dealing with.
Now there's two parts of it. If we're talking about business buy sell,
yeah,
that is usually used to buy out the interest, because if you have a company that's running and you have somebody that passes away and one person is going to buy out the decedent's, or the company is going to buy out the decedent's interest, that money is usually used for the purchase price, so that you don't have to have the company take out a loan or hurt cash flow. So in the buy sell, that's where that comes in. Now on the personal end, you want to think about getting insurance also, depending on your estate, your liquidity, and how much you got, and what tax consequences your estate might get hit with. That's when you want to think about, well, should I hold some insurance also? And does it make sense? In many cases, it does make sense to have insurance. Got some guys that have enough insurance already in their bank account where they don't necessarily need it. And that's when speaking to Jay and figuring out, well, what kind of insurance is right, how much is a discussion that you want to get us involved in. So the buy sell insurance is used to buy out the interest, and the other end, on the personal end, that will take care of any estate tax or inheritance taxes. That's how you should bank for that. So you actually want two different types of insurance depending on where you're at.
Okay.
Yeah, and I'll add to that, when you're dealing with personal estate tax, like when business is transferred, again, whether or not there's a step up in basis for the value of the business or not, and whether the family is going to have any kind of capital gains tax. The other, when you're thinking about what you're talking about, Tabitha, I think is probably more appropriate for like a second to die policy, where if your husband predeceases you and you get a lump sum of money for the business that he owned, and now you're worried about the amount of money that you have, and if you pass away, what the estate tax is going to be, you can buy a second to die policy, which is a policy which underwrites both you and your husband, and basically will pay upon the second death. And that's, we haven't done those policies in recent past because the threshold is so high and so few people have to worry about estate tax. But, we're entering back now where people may have to start worrying about that. And we'll probably see an uptick in those type of policies. So that's more geared for the estate tax, to cover that type of tax would be the second to die. But, some people do self-insure, and if there's enough money in the buyout of the business, maybe you can set some of that aside to create that. But that opens up a whole nother, set of personal problems. And do you move money into a trust? And do you gift before you pass away? And I mean, that's a whole nother strategy aside from owning the business and transferring the business value to the surviving spouse. So, once you've decided all of this, I think it's important to know that, just like your business on a daily basis is evolving and growing, there are things that you can't forget about. And, when you set something in place, you can't just set it and forget it. It's something that's got to be reviewed, and beneficiaries should be checked. Updates to the buy-sell agreement. Maybe the value of the business has changed. You bought a buy-sell agreement 5 years ago, or you put a buy-sell agreement in place 5 years ago, but now you bought more properties and the value is worth more. How do we make up for that difference? Again, the business value. Are you still funding the policies the right way? And have any other circumstances changed? Mark and I were talking earlier, and one of the things I think that, I don't know if we touched on it earlier, Mark, but was when you're adding business owners to the business, you may be a business owner today and you may have a few properties of your own. And Scott, you guys did this, right? So you guys each individually had your own real estate investments and you have your own corporation, but then you decided to kind of get other people involved to raise capital to buy bigger properties. Mm-hmm. So, when you're adding people to the mix, how do you make those changes? And Mark and I were talking about, that's one of the things that most business owners don't consider. They put plans in place because it's just them, but then they bring on a partner or they bring on partners. And that's certainly going to change. So I'm going to pass the baton back to Mark so you can talk about that a little bit, because we were talking about it earlier. And I think for this group, it's especially important.
Yeah, sure. When you're talking about bringing on an employee or bringing on kids, and listen, I mentioned this earlier, but you guys are here because you want to be. You're listening because you want to listen. There are a lot of other things that you could probably be doing. And at 8 o'clock at night, you're here listening to us speak. And so I'm hoping that something resonates with you guys, and you either call us or you call your advisor, and you try to develop a plan that works. If you're thinking about bringing on an employee or passing on something to the kids, there's so many ways to get this done. And the person who develops the plan should understand what's important to you. And you should be able to express that and share with them what's going on with the company, what's going on in your life and your family, and what do you like and what do you not like. And that should be built in. There are trusts that we can set up. There's all different kinds of those. There's LLCs that could be set up. You could have a trust on an LLC. We can go on and on about ways to structure this. But anytime you are, let's say, the sole owner, there's going to come some point where you'll have to make a decision, and it's best not to have it made for you, or leave it up to your family to have to go to court to figure it out, to divide up assets. Put the plan in place now while you can and while you're able to do it, so that you can carry out whatever wishes that you want. Don't make people guess. And this is not just about when you die. This is about the succession plan and the future of the company, and you still being around to see it grow. That's important too. This is just not about when you exit, this world, or the company. This is about while you're still here, you could still be active and share ownership, and maybe even grow the company a lot more than you've already done it. And so there are a lot of pros to it, and there are some drawbacks that you should be aware of. Who are you giving it to? Is it the right fit, the right people? A lot of things to think about. And then that's why you need to have the discussions now.
Yeah. Hey, Mark, I just want to give you an opportunity because earlier we didn't have your contact information up. That I rely on you for a lot of these conversations when working with clients, and because your knowledge. So why don't you please share your contact information? Because if anybody wants to reach out to you, I'd like for them to reach directly out to you and ask you the questions they may have regarding the law and your area of expertise.
Well, thank you. You saw me looking away a little bit. I already set something up and hit enter as you're saying it. So that's done. I sent you a link to our website, and that link is my bio with my background, what I do, and you can see a little bit more about the firm, the work that we do. We deal with a lot of real estate developers. Whether or not you're buying or selling an entity or real estate, you're doing 1031, or you're trying to create a use on your property or get a variance. We appeared before Board of Adjustment and Planning Board a lot. We're known throughout the state and in many states for what we do. We represent a lot of really big companies, national companies, global companies that want to do work in Bergen County and surrounding counties. And so if you have any questions about what you can and can't do with your property, that's also something that you can reach out to us for. We're great at that. And our firm is known for that. Like I said, we started out as a land use firm. And from there are companies and estate and litigation, and a lot of that follows. And, so you don't just get the benefit of me, you get the benefit of my partners and the people at our firm that do what we do.
Right.
Yeah, it's in the chat session for those that are here. Being that you're sharing, I don't know if you want to can you pull up the chat, Jay?
I could pull up the chat.
Because it should show, maybe it'll show on your screen.
You mean to show the chat?
Yeah,
Yeah, for whatever reason, the chat is not working when I'm sharing the
okay.
screen.
I'll have to do it when we take control back, that's all.
Yeah, and again, this is my contact information. My goal tonight, let me just share that, and Mark too, I know in our profession, there are so many variables when it comes to this type of work. We can bore you to death. The reality is, and what I really was hoping to get out of today's conversation with everyone here was just kind of like strike a nerve to get you to look into it and not get like into the weeds, and having Mark here to kind of talk about the legal background for all of this, I think has been very helpful. Just understand that there's so much more that goes into this. And we just wanted to bring awareness to, running a business is not just opening the door or getting up in the morning and, or dealing with that. Running the business is these decisions here. And quite frankly, probably one of the more important decisions you have to make as a business owner, because if you're not properly prepared, what are you really doing it all for? If you're no longer here, what's the benefit to your family for all your hard work? So I'll go ahead and stop sharing now. I want to thank everyone for your time. I truly value the opportunity to work with all of you. So thank you very much for allowing me to join your session and your group tonight. And if I can answer any questions, like Mark, please feel free to reach directly out to me, and I'll be more than happy to do that.
Yes, I was searching I ran to go get my notebook because there was a question that I had written somewhere, but that was like a while ago. So now I can't find the question. I mean, because like you says, we do have, there's the 5 members in our new company that we started.
Mhm.
So that's
I put Mark's chat up
info,
so you can get the link.
and you,
We can't see the chat though.
Can you see it? No, you can't see it?
all you
You
see is
guys-
us.
You guys just Google
What
me.
happened?
I'll come up pretty quickly. If you can see my first and last name right on the screen, and if you Google that, you should get our firm pretty quickly as a hit. If you look up Mark Bally and you type in Wells Law, I should be your first hit. If you can't see the link that I just sent everybody.
Okay.
Gallery view.
No, it was, I had it up. When I looked at it before I shared it, the chat session was open, but
No, but you should have,
yeah, it is.
which is weird because it's only the 3 of us on there.
Let me try doing it again.
What
no,
the heck is going?
Jay,
There is something
Thank you.
up with technology today.
Jay started sharing the screen again.
Ah, you gonna draw the pictures out? That's
I
what
was, I was gonna write it out, but that's all right. So does anybody
Um,
have any questions regarding, anything that I mentioned? I mean, I kept it pretty basic. Mark really got into a lot of the details. So if you guys have, any questions, so someone wrote here, if you have
Yeah.
multiple LLCs for your properties, is it advisable to have a master holding type like a C Corp? So Mark, I'll defer that to you.
Sure, this is, I'm dealing with this right now. I'm representing an estate where the decedent was an estate planning attorney, and he left multiple properties that he owned to his 2 children and to his spouse in trust. So it's 50% trust, 25% one daughter, 25% the other daughter. There's about 13 properties, and these are all outright. They're not held in any kind of entity. And so the daughter said, what should we do, Mark? Is there something we can do in order to make this a little bit better? Can we protect ourselves? What should we do? We rely on you and our accountant. And so what we've done is we've set up a parent LLC, which is going to own all subsidiary LLCs. And each property is going to be held in a separate LLC, and they can grow it. They can do what they want with the properties. It divides the liability up. In this case, there are no mortgages, which is great. But if they decided to get a mortgage, having it all lumped up in one is not the best idea. And you think to yourself, well, all these LLCs, should I do that or should I not? They're disregarded entities. They roll up all into the parent LLC, and K1s get issued from there and gets reported on your 1040. So you don't have like 15, tax returns to pay taxes on. Everything gets rolled up to your 1040, and there's an 1165 that gets filed, which is like a partnership tax return, LLC return, that gets prepared on the parent level, taken care of. So is it right for you? Well, maybe. We have some clients that say, no, I want one LLC. I want to throw all the companies in there, and I don't want to deal with all these LLCs. I want to have adequate insurance, and that's it. Well, that could work, and that could also blow in your face. And you might not like that. So we'll give you the pros and cons, and I'll give you a recommendation too. I won't just tell you pros and cons and not help you make a decision. My job is to help you do that. So, is it right to have multiple properties and different LLCs? It's the prudent thing to do. It's the trend. It's what most people are doing and what most people want. And a lot of people seek protection, and that does offer you the maximum protection.
I think that's my favorite answer, and it's one that's like the go-to when we're doing these things. Like, Mark, is it right for me? Well, maybe. We don't know. We have to talk about it more. So
Yeah.
we can't always give the specific answers that everybody. But any other questions for myself or Mark?
Lisa asked, if you own multiple properties, should you put each property in different LLC and then put all under one trust? I guess it would depend on if you're flipping or holding them. If you're holding them, that's a different strategy than flipping, right?
Well,
Well, I mean,
it's a good question. Because think about it. I mean, we know somebody that went to work and was gone.
Yeah.
Literally went to work, showed up at work, got out, not even probably at work for an hour, and was gone. And that's it for the rest of his life. So everything that he owns, if he didn't put everything where it should be or take care of it, what do you do?
Yeah, I
you're
mean, I don't necessarily know off the top of my head. I'm trying to think of the benefits in having different LLCs. I mean, they're all limited liability. So, Mark, I mean, do you have a comment on that?
Yeah, I mean, what I was just saying kind of speaks to that a little bit also is having each property in a separate LLC gives you that limited liability protection as to each and every property also. So if they're all lumped into one, and let's say somebody slips and falls and they sue you and a lot of damage, assuming your insurance doesn't cover enough, or there's some sort of, exposure there in terms of something malicious you did, or just pure negligence. Let's just say something happened, it was an accident. If you have all the properties in one LLC, well, the liability that is limited is everything that's in that LLC, all of the properties. If something happens on one property and they're all in separate LLCs, well, the liability generally is limited to that one LLC. So you've separated everything. As the question about a C Corp or something, pretty much no, not a C Corp. But if you have a management company and you're working and you're paying yourself and you're getting W-2'd and stuff, a lot of accountants will say, set up an S Corp. There are benefits to that as opposed to an LLC if you're working. So that's one thing. It's just owning real estate. LLC is a great idea. If you're working and paying yourself and managing and want to do that, S Corp is a pretty good way to go. So you can have multiple types of entities relating to your real estate industry, and your empire.
What about if you're not? Would putting them into a trust be a better idea?
Putting them into a trust. Well, like I said before, you can have a trust and have that own an LLC. So you can have layers. The question is, well, why put it into a trust? Right. And what's the right trust for you? Is it a revocable trust? Is it an irrevocable trust? What kind of irrevocable trust is it? Is it an intentionally defective grantor trust? Is it a gifting trust, generation skipping trust? What kind of trust? And why would you want the trust in the first place? And so if you're putting it into a trust and it's irrevocable, well, the property is not yours anymore. There are great reasons to want to do that, but there's also reasons why you might not want to. A revocable trust is yours. It's in your name. It's under your social. You control it, but it doesn't give you that kind of limited liability protection. So there are reasons why you might want a revocable trust, and I can get into that if folks want to have a chat offline. But generally speaking, a limited liability company is a really good way to go when you're dealing with a real estate.
Right. So trusts are like another whole presentation topic, basically, because they go pretty deep.
Yeah, topics. Yeah, for sure. Yeah. And glad to get into that stuff. But it's I don't want to say it's complicated. It is, but there's a lot of pieces to it, and to find out what is right for the audience and what the people want to hear would be something that would have to be planned in advance. Yeah.
Right. Like you said, it's based on, I guess, what is their need and what they require over what they think they might need, right?
I'll say this: if you own properties in states other than the state in which you're domiciled, really good idea for planning purposes to put that into, at the minimum, a revocable trust. I'll go that far with it. And that could be in an LLC and owned by the revocable trust. The reason being is that your family probates your will, let's say in New Jersey, you own property in Texas. Now the family has to go, your executor has to probate the will in Texas too. Manslaughter probate, right. 2 administrations. Avoid that by putting into a revocable trust. That can avoid probate. There's still tax issues. You still got to think about that. But it'll avoid an administrative headache dealing with more than one state. So yes, and that's one of the questions I do ask. Do you own properties in the state of New Jersey or New York, wherever you are, the state in which you're domiciled? So good question, and there are reasons for it.
Cool. We have from iPhone, I'm not sure what that is, key person insurance. Can you take a policy out on your GC that does all your work on house flips?
Yeah, so what I'll say to this is that anytime you're purchasing a life insurance policy, there has to be an insurable interest on the insured. So if I'm buying a policy on someone, there has to be an insurable interest. I think what's going to come down to is, if they do all the work for you, how much work they do for you. I don't know if you necessarily need to have that, because are they that irreplaceable? And how much loss to your business? And don't get me wrong, I know that there are good GCs and bad GCs, right? But
Yeah.
how much?
Say that again.
If you're using a GC and you're buying a lot of properties, and this person's almost like a full-time employee, and your business is gonna suffer economically because of the passing of your general contractor, then there's an argument for it. But I think that there may be a little bit of pushback if that GC is not working for you exclusively, and there's not like a reasonable amount of work that's being done for you on a continual basis, and we can't illustrate that your business is going to suffer financially from it. But if you're buying multiple properties and this is someone full-time that's working for you, and they're responsible for making sure your properties are up and running and get the COs done, and if they are not here, it's going to take you 6 months to a year to replace them, then yeah, I mean, there's an argument for that. But anytime you're looking to buy a life insurance policy, there's got to be an insurable interest in order to obtain that policy. You can't just buy a policy, on someone for the sake of buying it.
Right, plus the cost that's associated with it, right? Like, how are you gonna value their worth? What
Right.
kind of policy would you purchase? Like, how much of a limit would you put on that?
Yeah, yeah.
I guess if you had like 5 properties right now, he's managing them all and doing them all, then that could be something like $1 million or up, right? But that all has to be taken into consideration, I think, before you can just go out there and put a policy on it, like you said.
Yeah. I'll give you an example, like a restaurant that has a chef, right? Everybody goes to the restaurant to eat the chef's food. And if that chef dies, well, the quality of food can go down. It could take time to find a chef that's just as good. And therefore, the restaurant owner might buy a life insurance policy on the chef because he's going to suffer revenue losses until he can find a chef that's the same quality or can produce the same quality of food. So again, to your point, Scott, as far as project management, managing the properties, if that general contractor is responsible for running 100 properties that you have, and if that person died, it's gonna you're gonna have to hire somebody, you're gonna have to find someone, and yeah, there's gonna be an economic loss, and there's certainly an argument. But if this is a GC that you're using once a year or twice a year every time you buy a property, probably not enough insurable interest.
Right. So no questions there.
No more questions
I had
here.
something that I don't know if you have the answer to it, but I saw it on your slide at the beginning. A tax exempt entity.
Mhm.
What is that? And is anybody eligible to have a tax exempt entity, or is it specific? I
Well,
guess.
it's something that we all want to be, but
Yeah.
unfortunately, a tax exempt entity is like a nonprofit. Creating a nonprofit that's not in business to generate a profit, or that the money that's used is to go towards the greater good or the cause for the business. Other nonprofits could be like education, hospital, churches. I don't know of anybody on this call, unless you want to create a charity of some sort, would qualify for non-tax entity. Mark, do you have any creative ways that people can invest and be a real estate owner and be tax exempt?
Well, you just said it right there, invest. If you're thinking about investing and making money and growing something like that, well, that's, purely for profit generating purposes. But we have clients that want to set up a private foundation. They want to donate property or money, and then they want to have that foundation make donations to other charities and causes. That's great. we have clients that want to do that. And you can certainly, you can give stock into the foundation, and then the trustees can figure out what they want to do, and the directors can figure out what they want to do in terms of gifting that over. And there are all kinds of planning mechanisms that you want to keep the income for life, and on your passing, you want the asset to go over to charity. Yeah, but off the bat, if you have real estate, you're in for profit, you don't really qualify for as a tax exempt entity. The way to do that is to set up a foundation, or donate to a charity, or implement planning that can offer some tax benefits. Like I said, keep something for life, keep the income for life from the property, and have the property be donated to charity in the passing. There are deductions that you can get for that.
Okay. I only mentioned that because there was another piece to it this last week. We were on I think it was in the clubhouse.
at
They were talking
Clubhouse.
about it, that I don't know if anybody knows, there's 0% interest mortgages out there right now. I'm sure it costs a little more to get, but you pay no interest on the loan. So that's why I was like, tax exempt entity, 0%
Due
interest
to
loans
religious reasons.
due to religious reasons. So I was just like, huh, that's
Why are you
interesting.
laughing? Have you heard of this? I've never heard of this until
Last week, yeah.
I was on there. They're laughing. They know something we don't know. Come on, hand it over. What do you know?
I'm laughing because it's just one of those creative things that the IRS is going to love to look into. That's why I'm laughing.
Okay.
Okay.
I just found it interesting. I'm like, what? They have 0%? Because there's people
Due
investing
to religious
right
reasons.
due to religious reasons. They're in Canada investing here in the United States, getting loans here at 0% interest. And they asked on the conversation, does Canada offer 0% interest loans like the US? And we were like, wait a minute, the United States is 0% interest. What is that? How do I get involved with that where I'm not paying any interest to
All
the
right.
bank?
So what do you know, Mark?
It's same lines here. I mean, it's like, what are you trying to do? That doesn't matter as a smell test. Not going to work. If you want to, some people, okay, you want to be a priest, the property, you want to turn your property into a church, for example. Okay, it's got to be real, and you can't call it a church and rent it out to tenants and start making money off of it and say that tax exempt. You don't want to pay property taxes. You don't want to pay income taxes. You don't get the best of both worlds in that case. Now you can have a nonprofit make investments. It can invest and get interest or dividends and stuff like that. That's permitted. But you just can't turn it into some sort of profit generating entity that distributes money out to owners, because there are no owners when you're dealing with that. So that's really is a key difference. It's for charity.
They would have like a board with a CEO and all of that on there.
Yeah, like a real charity. You have the CEO, you have directors, you have trustees. They meet, monthly, and they come up with applications and what their cause is and what their mission is, and if they're seeking donations, or if it's a foundation, you're not typically seeking donations. If you're a private foundation, you're actually looking to give money. If you're a private foundation, if you're a public charity, that's when you're typically seeking to have people donate to your cause, and then you're going to do something with it or donate to another charity or so on and so forth. So there are differences, and there's an application with the IRS, you get set up, you form a company, there's a whole process. But if you're just really looking to pay like no taxes, that's tough. And if you're making a lot of money, you have a lot of taxes, like, okay, well, it's a kind of a good thing, you're doing well, but how do you mitigate it? Now that's probably the question you want to ask is, how do I pay the least amount of taxes as possible within reason?
Yes.
Right.
That's where we can help.
Yeah, absolutely. And, I would just say this, that I find oftentimes when people find some way to circumvent the pain points, they create other pain points for themselves. So, I mean, sometimes you think you're getting over with one thing, but it affects you another way. So, I think it's, sometimes you just have to deal with the situation and like everybody else. So.
That's why I figured I'd ask, because I'm like, I never heard of it. And it raised a flag to me, but I'm like, these people are talking about it like it's a cakewalk and they do it all the time. And I'm like, I've never heard of this.
I'd love to pay no interest.
I mean, but if you consider this, right? Like, so my interest rate on my property is very low. I mean, interest rates were low historically. They're creeping up again. But the reality is that, you know, depending on how much you're borrowing, if you did, you know, if you looked at the amortization chart and you determined, okay, over the life of this loan, this is how much interest I will pay, and you have a low interest rate, the company, from a marketing perspective, I guess, can just say, okay, we'll give you no interest. We're just going to charge you up front. Instead of waiting 10 years to get our money, we're just going to get our money up front from you. And you're not going to have any interest payments. I mean, I don't know if that's what they're doing, but I don't see
Yeah.
benefit.
No idea. I just was just like, whoa, that's kind of weird. Never heard of it. So,
All
any other
right.
questions?
No.
I got to throw one more thing at you, Jay. I think I mentioned it to you. I don't know if you had the answer. IGIC,
IGAC,
IGIC.
IGIC.
It's an insurance it's an investment something insurance, or it's for insurance. It's a way to reduce capital gains tax. I guess it's an insurance policy where you create an LLC, the IGIC owns the LLC, and that's where you put your investments. And I don't have the all understanding of it because it was some other person that I had a brief conversation with.
We're talking about an insurance-only LLC where in order to avoid the perception that the trigger of the payment of a policy might cause capital gains tax or something like that, you set up a different LLC. The sole purpose is to own the insurance and to try to get around having to pay, let's say, income taxes on that payout, because the company technically, let's say, came into a windfall because it got a huge, $1 million it got, somebody passed away. There was the position that the IRS could tax you on that. Is that what you're referring to?
Well, it's an insurance thing that billionaires use, basically. This is how it was described to me. Well, no, because it's just that most people don't know it's there. And it's a form of a way to invest where you create this LLC, the IGIC owns it, and your properties are like, it purchases the property, right? And say it's an apartment building and you have this loan, the IGIC can pay up the loan quicker, and you don't pay, like if you sell it, you don't pay capital gains because it's the IGIC actually owns it, not you. So therefore there's less capital gains that you would have to pay because of the way it's formed and created. I just heard about it a few months ago and I was like, I got to look into it. I haven't had time to look into it. So that's why I figured I'd ask Jay, because it's his realm. He might know about it, but maybe
Well,
he
I'm
don't.
afraid you embarrassed me, Scott, because not something that I'm not really familiar with. What it seems to be is, I'm looking at it real quick. Life insurance offers a deferred growth of taxation. And then generally you can take loans from the policy and not pay tax on the gains. And so what I'm looking at here is essentially, it looks like it's an insurance policy that's purchased that allows you to basically, instead of taking the profits from the business and paying tax on it, it goes into the insurance policy and it grows deferred. And this way you're not paying tax on it. I gotta be honest, I don't know of any companies, that are selling this type of policy, but it seems relatively new. That's what it seems to be to me. I will certainly circle back with you and do some more research on it. But that's as far as I can go. Mark, do you have any other commentary on that? Have you dealt with this at all?
One other option is if clients like to set up like a self-directed IRA or use a retirement plan to buy real estate, sell real estate, move things. So if you're dealing with something that is tax deferred, or you don't just have to buy stocks with a retirement account. You can buy real estate. You can buy and sell real estate so long as you're not living in it and using it for personal use. You could do it for investment purposes. So some people say, you know, I don't want to invest in stocks anymore. I want to diversify my my portfolio. Well, your portfolio is not just limited to what you have, you know, let's say in a brokerage account. It can also include what's in your retirement account and can make its own investments also. And people like doing that and growing it. That's also a good way to do too. So there are multiple methods and vehicles that you can set up or purchase in order to maximize, you know, consequences.
So what I'm reading here as well is that it basically is a permanent life insurance policy that you're overfunding with the profits and allows your money to grow. So essentially what you're doing is, you know, it's just a fancy name for an investment grade insurance contract. It just says that it's a permanent life insurance policy that is set up the opposite way, you know, that insurance companies tend to set it up. So it's basically using the profits that you gain, you put it in a life insurance policy, and because of the tax code that allows you to grow a cash value and not pay tax on the gains of that cash value, and then to pull it out without paying taxes by your loans, that's the strategy. But it's not a particular insurance product, it's a strategy using permanent life insurance.
Strategy. Gotcha. See, that's why I wasn't sure, because I think it was presented to somebody that dealt with insurance.
Yeah.
Said it to me, and I was like, I don't know anything about this, and I have to find out, you know, more about it, because it sounds like it's an option for that purpose. You can grow the insurance policy. You can borrow against it, tax free. So, but I don't know if it's worth going into doing that, because I don't know what it costs and, you know, the relative value of it.
Well, look, you know, when people can't save money, for an example, you know, if you make a high amount of money, you may not get all the benefits that the government offers to save for retirement. And you may not be able to put, like, you're capped at what you can put into a retirement account. And then there are thresholds of income and how you can save money. So, you know, tax is obviously one of the biggest things in retirement that you have to deal with. And we don't know where taxes are going to go. You know, if you're 46 years old, like I am, and I plan to live to 90, you know, I have 44 years of taxes to deal with. I deal with taxes as I'm saving for retirement, and I'm going to deal with taxes when I am retired. So, you know, how do we save? Do pay now, pay later? Life insurance contracts. So when people can't save enough money, you know, with business owners, we talk about non-qualified deferred comp plans. And it's usually using a life insurance policy, which you build up this cash value. And if you die prematurely, the life insurance policy basically insures your retirement. But if you live a long, lustrous life and you save a ton of money in this cash value, now that cash value almost becomes like a pension to you when you retire. So essentially, that's more or less what they're talking about as I'm reading this. But it's more of a strategy, and I think it's just a fancy way of attracting people with investable assets to buy life insurance. And I'm not saying it's not suitable, but from what I can read, that's what it is. And obviously, there are different types of permanent life insurance policies. You have fixed interest rate policies, you have whole life that pay dividends to grow the cash value, and then you have variable contracts, which uses, you know, the market and investments like mutual funds and asset allocation accounts to grow the cash value in the life insurance policies. So essentially, you're just using a life insurance policy. The problem is, though, when you do these type of plans, is that you don't get a write-off on the contribution. So it's not like if you set up a SEP or a simple or 401k or, you know, something like that, an IRA, where you can write off, you're not really writing off, you're just reducing your income by that contribution, and then you're paying tax on it in the future. So like a Roth IRA, for an example, you take your income today and you pay tax today, and you make your contribution to the Roth IRA, or if you have a 401k or Roth 401k, and now all of your contributions have already been taxed. So the contributions and all of the growth is now tax-free. With life insurance, you're doing the same thing essentially, except for it's in a life insurance contract. You know, life insurance also provides some creditor protection, like, you know, the ERISA rules with the retirement plans. But you're just, and if you buy $1 million policy, you may be able to put $70,000, $80,000 a year into this policy, because it's based upon how much the cost of insurance is, how much you can put in there. So if you could put 80 grand into a life insurance policy, invest that in assets inside the policy, not pay tax on it, and have it defer growth. And then when you pull it out, it's all tax-free because life insurance allows that via loans, and you're just basically taking loans out of the policy until it's surrendered. That's basically what that contract is performing as.
So you can actually, because even with the Roth, you're limited by how much a year you can contribute, correct?
Yeah.
Well,
Right.
you're limited two ways. You're limited, number one, by your income. If depending on what your filing status is, whether you're single, married filing separate, that's the worst. But you're limited to what you can contribute based upon your income. There are thresholds. There's the backdoor Roth where you basically fund a traditional IRA, but you don't deduct it and you can add more. I mean, there are multiple ways of doing it, but yeah, when you're dealing with qualified plans or like a Roth 401k or an IRA or anything like that, there are going to be contribution limits. There's also going to be limits in an IRA based upon your incomes, and there's going to be phase outs if you're making too much money. And that's all based upon the AGI when you file your taxes.
Right. So this would be just a strategy that would allow you to put more into it if you wanted to without having that limitation.
Yeah, I mean, I'm doing it for a client now that needs to save a lot more money for retirement. He just doesn't have a way to do it with what's available to him. The amount he needs to contribute to his retirement account or what he wants to contribute to his retirement account, there's just no other vehicle that'll allow him to do it. So by buying the life insurance policy, he needs it anyway, right? Because life insurance should be bought for life insurance, not for an investment. But he needs the insurance, but he's going to overfund the policy so that he can get that tax treatment.
Right. Good point. Good point. See, I was missing that point right there. It's another way to invest more money than what you're normally allowed to contribute to a regular
Yeah.
type of
Where you have it
retirement
sitting
fund.
there, yeah.
Yeah, yeah.
Let me give you something else.
They
Like
have more to
when you
spend
do-
when you're gone, honey.
let me give you a strategy. When you're dealing like a whole life policy or a universal life policy, even you have ability. Like there are business owners that will contribute a large sum of money into a cash value policy, and there's something called direct and non-direct recognition in the cash value. So let's say you have $200,000 sitting in cash value in a life insurance policy. Let's say you need to borrow 100 grand. You can borrow 100,000 out of your cash value, still earn interest as if the money were in the account, use the cash value, buy what you need, and then pay yourself back.
Right.
I have a question. Now that you mentioned that, because we have 5 people in our company.
Mhm.
Is there a way to do a policy where it's on all, one contribution goes in and then later on it has to all be individual?
Yeah, I mean, there are plans, and this doesn't really work well with an LLC or an S corp because they're pass-through entities. But there are what we call executive bonus plans that business owners will use to create a quasi-retirement plan, and taking income from the business to fund this type of plan. But from an LLC, and to answer your question, no, there's not like a master life policy. You can do a second to die, but that's typically through spouses or closely related parties. But that's separate, that's different. And, but there's a lot of creative ways that people use life insurance, to grow money. It really is one of the oldest, tax favored vehicles when it comes to creating tax-free income and growing money tax deferred.
Yeah, we have to keep that down a bit because if they catch wind, they'll start figuring out a way to tax it.
Well, they actually just changed
We're
it.
in Jersey. They tax everything.
No, in 1988, they put into effect how much they capped it, what you can put into it. But they actually just changed it where they raised that number. So now you can actually put more money into it. Let me tell you this. This is the creme de la creme for any insurance company. This is how they get really big premium policies. So the insurance companies have very good lobbyists that make sure that this treatment doesn't ever go away. That's just fact. This is something that, insurance company, because the minute this goes away, those big premiums go away because the people that are taking advantage of this are putting some serious dollars into their policies.
Right. Yeah, without a doubt. That's good.
Mark, did I break any rules? Did I break any laws?
The 8:30 rule. That's the only one.
We always go over. It just happens that way. We get into conversation.
Yeah.
But the one thing I wanted to throw out there, not a question, just a statement, is that I was thinking about it during the conversation, listening to you guys talking, is not only is it a benefit for the business and your succession, but to do something while you're in business to protect your investors is also a key component. So, because you don't know what's going to happen. If you got 5 projects going on with money coming in from 5 or 6 or 10 different places and something happens to you, how's that going to get paid back, right? If that's not set up right, yeah, great, you have an LLC, but what's going to happen with that project, that funding, that the people that put the money into these deals, like, you know, so if you had the strategy set up ahead of time, because most people don't think about that either, and then next thing you know, something happens and it's like, ooh, you know, what can happen? They have to try to liquidate the asset, but if you're halfway through a construction build, right, and the money, 3/4 of the money's been funded or something, like, what happens in something like that? Like, okay, so now your family has to now take over this sole proprietorship LLC you created, and they have no clue what they're doing, and try and get these projects done or sold when you didn't have your LLC set up with some sort of backing to protect that. You know,
Yep.
I was like, wow, that's a big component, right? Have you
Absolutely.
guys ever come across that where you had to go through that?
Look, you know, as with anything, I think most people that I deal with, most people that have an interest in a business is going to require some kind of guarantee. You know, whether it's a personal guarantee, financial guarantee, or some kind of life insurance. You know, people that buy businesses and get loans from the SBA requires a life insurance policy when you get a loan from the SBA. You know, the banks require it generally, and they're assigned the contract, so they get paid. But yeah, I mean, that's a big part for life insurance. And, you know, when you can't qualify for life insurance, then you got to create a sinking fund for that in the business, which is going to be money set aside to take care of these things. And that's all part about being a responsible business owner. Like I said, it's not just coming into the office every day or coming into the workshop and doing what you do for a trade. It's protecting your business and making sure that you don't leave, you know, a problem for your family and those that you leave behind, your partners, etc. So.
Have you guys ever had to deal with somebody that didn't have it set up though? Have you ever had to go through the process of helping them liquidate or do something?
Yeah, I mean, look, it happens. I'll tell you right now. So one of the higher end landscapers I used to work with, he, you know, back when Madoff lived in Connecticut, I think he still takes care of the family, still takes care of the property. But, you know, he was a very big landscaper, made a lot of money, died prematurely, and his wife, you know, lost half the business because she couldn't maintain it. She didn't know how to run the business. Yeah, so it happens all the time. And there were contracts out on equipment, on trucks. They repossessed half of them because she didn't have the money. She didn't know how to run the business. I mean, you know, he went from making $500,000 a year, you know, net, to where she's barely, you know, making $60,000, $70,000 a year now from the business because they lost a lot. And, you know, a lot of things were repossessed because there was no money to pay for it and there was nothing there. So, I mean, it happens. It happens.
Right.
But
Yeah, that was my thought on that. I'm part of that whole part of the conversation tonight. I was sitting there thinking about it, like, yeah, what about that? Like,
Yeah.
you know, like a lot of people set up LLCs because they're protecting themselves, but they don't fully protect their clients.
Yeah.
Not thinking about not doing it, it just doesn't come across to them and say, oh yeah, I got to do this, you know. And every once in a while you get into a conversation like this or a topic or a discussion and you're like, ooh, I got to do that. So I like that. That's why I like to have the meetings with people like you on here. You know, I appreciate you guys coming on tonight, taking your time and, you know, having this discussion and conversation with everybody that joined the call. And I will be posting it on our YouTube channel, which is not CNJ REIG. It is our company, Diamond in the Rough Properties. So we have other videos up there from all our meetings that I've been recording and posting up there. So if you want to take a look back on it, you're more than welcome to.
Guys, I see one that this is looks like it's being recorded live on Facebook. Looks like it's going on YouTube.
Yep.
We talked a lot about it, a lot of stuff today. One thing I'd like to say, listen, if you're thinking about acting on something that we talked about, don't call your advisor, call your lawyer first, have the conversation with us, but don't just go do something because you heard it here. All the facts and circumstances will be very different from your situation to somebody else's. And in order to figure out what's really right for you from a tax perspective, from a planning perspective, insurance, advisor perspective, you got to speak to somebody who's going to hear you out and specifically tailor the plan to your circumstances. So don't act on what we're saying here, but take this advice and use that to think of what you should do for your company. Reach out to your advisor, reach out to your lawyer, give us a call. We'd be glad to help you out.
Yep, and that's exactly what I was gonna say. If you don't have anybody, give Jay and Mark a call.
Lucas, yeah, your contact info.
He-
It was up in the
It
chat.
was up on the chat.
I don't know. I was on Watch Party and Facebook Live.
Yeah.
I
so-
think you can Google either one of us. I mean, I come up pretty easy.
Yep.
You know, and Mark is fairly easy to find. Google our names and there'll be more than one way to contact us. But, you know, thanks again for having us. You know, Scott, it's a relationship in the works, and that's how we work, by building relationships. So thank you very much for allowing me to join you tonight. Mark, I got to tell you, you know, you're an invaluable asset to my team. And thank you very much for spending the time, you know, here with us tonight and contributing as much as you did. You really brought tremendous value to the presentation. And I couldn't have done it without you. So thank you.
Thank you.
Okay, so
Yeah.
everybody wants to unmute and say thanks. Give
Yep.
it up for these guys.
Yep, thanks for coming on.
Absolutely.
Appreciate it.
Thank you guys
Um,
so much.
Great wealth of information that we got tonight from you guys. And like they said, don't act until you go talk to the professionals, which includes Mark and Jay here. And again, appreciate you guys for coming on and spending the time and providing the information.
I am going to be calling Mark as soon as I find my question because it's somewhere in my notebook.
All right, guys.
All right,
Have a
guys,
good
thanks
night.
a lot.
Thank you.
Have a great night.
Okay, guys. Have a good
Talk
night.
to you
Bye
soon.
now.
Thanks.
Bye.